All right, so we've got another example of how to record some Treasury stock transactions. This one is a little bit more involved. As with the previous video, we will not be using journal entry explanations in the interest of time. So I do believe that journal entry explanations help with the overall understanding of the material. So if you want to just pause the video and make those journal entry explanations as we go, that's great. If you are in one of my classes and I've either given you this handout or you've printed it off, if you're in one of the online classes, do note that you're not going to have enough room to do this. So I brought in an extra sheet of paper and kind of laid it over that so that we could kind of see this thing unfold. All right, so I'm starting off with the date of March the 1st. That is not in the question. I just kind of made that up so that we would have a date. So let's dive into this. This is a little bit more involved than our previous example. It says a company has 10,000 shares of $10 par common stock outstanding. Prepare entries to record the following. So requirement A says that they're going to purchase 1,500 shares of these 10,000 shares. They're going to repurchase those as treasury stock at a price of $16, and that we are going to be using the cost method. There were no previous purchases of treasury shares, okay? So, how much did this cost us? Well, we bought 1,500 shares at a price of $16. So that's $24,000. So what went up? Treasury stock went up to the tune of $24,000. And we used cash to do that, to make that happen. So we have to credit cash for the $24,000. And that's it. Now requirement B says that we're going to sell 1,000 shares of treasury stock at $19. And so we're just going to say that this happens 1 month later. So this March 1st transaction here, I'm going to put the letter A right there. And then, so this is April the 1st. Let's put B over here to the left. So it says that we sold 1,000 shares of treasury stock at $19. So 1,000 times $19 received per share is 19,000. So our debit is going to be to cash for $19,000. Well, what did we give up? We gave up 1,000 shares of treasury stock. So we're going to need to credit treasury stock at cost for $16 because we're using the cost method. So 1,000 times 16 is $16,000. So we are going to credit treasury stock for $16,000. But just like in the previous example, we do not balance yet. So if we take $16,000 and subtract out the amount of cash, kind of doing this quickly here. I'm going to do that again. 19,000 minus 16,000 equals 3,000. You probably knew that. So we're going to go back to our account that we used before, and we're going to call that paid in capital from the sale of, try to get this actually written out this time, treasury stock for the difference, $3,000. And we have fulfilled the requirement for B. All right? Requirement C is going to take place on, and I may have to kind of go back and forth here. We may not be able to see the entire screen because I'm writing a little bit too big. Let's see here. Let me move this up here. We're gonna do part C here on May the 1st. Okay, this is C, and it says that we purchased equipment for $80,000, paying $25,000 in cash, and issuing 4,000 shares of common stock for the remainder. Okay. So this is gonna throw us for a loop here if we're not careful. So let's just see what went up. Well, it looks to me like we've got some equipment. We've got an asset. So the first thing is we're going to need to debit equipment for $80,000. Now that's pretty simple. We also know paid $25,000 in cash as part of the as part of what we sacrificed to get this equipment. So we're going to have a credit to cash for $25,000. At this point, I'm going to move this up some. We're not going to be able to see the entire question, but we're already done with parts A and B, so that's okay. So we've got this detail here, 4,000 shares of common stock. So I'm going to be kind of moving back and forth. So we had 4,000 shares. Now notice what it says right here. This is $10 par common stock. Okay, so the par value of these 4,000 shares is going to be 4,000 number of shares times 10. Okay, so that's $40,000. Yes. So we're going to have an additional credit to common stock for $40,000. When we look at this journal entry, we can quite easily notice that 25 and 40 is $65,000, but we have an $80,000 debit here. So we're going to use our account. I'm going to abbreviate here. PIC always stands for paid in capital. Paid in capital, excess of par, common stock for the remainder. $80,000 debit minus the $25,000 in cash minus the par value of the 4,000 shares of stock. We still have $15,000 less, so paid in capital, excess of par, common stock $15,000. And hopefully you can kind of halfway read my writing. And that would be the end of that requirement. But we have one more thing that we have to do, and this is where I'm really going to have to move the page back and forth. It says that we sold 500 shares of Treasury stock at $14. So I just had an idea. So our D requirement, let's do this a little bit differently. Our D requirement is, or it says that we sold 500 shares of Treasury stock at $14 per share. Okay. All right, so we're gonna say that this transaction took place on June the 1st. Well, if we sold 500 shares times 14, we're going to get $7,000 in cash. Okay, so cash is going to be debited for $7,000. Now I am going to have to actually move this back up because I want to just show you, I want to remind you, if you've got the handout, it's a piece of cake. But if you don't have the handout, it's kind of hard to keep all this in mind. Remember, we purchased this Treasury stock initially at $16 per share. So that's what it has to go, that's what we have to credit it for. So we no longer have 500 shares that at cost is $16. So that's $8,000. So what we're going to do is I'm going to drop down a little bit here to credit Treasury stock for $8,000. So essentially what we have here is we're going to reduce paid in capital. And we're going to do that with the same journal entry that we did before. We're going to call it paid in capital from the sale of Treasury stock. And that's going to be for the difference between the $8,000 that we gave up in Treasury stock and the $7,000 that we received in cash. And that's $1,000. And if we, let me get rid of this calculator. If we go back here, we see that we have done A, B, let's see here, A, B, C, and D. And those were the 4 requirements in the question, so we are finished.